Hello again. Thanks for listening. This is Realtor Patka Powich, right here, 122 feet above sea level at the south end of the San Francisco Bay. Well, there's been a lot of talk about real estate. Prices are softening across the nation. Of course, in some pockets, staying strong. Interest rates have been on a rise. I've been here before. I saw that coming. Now, how can we, that is, the real estate community, buyers and sellers, work together and put together a transaction? Well, we can use loan officers and their tools such as buying down the interest rate. Buying down the interest rate. Now, how does that work? What is a point and why do sellers pay them? How does buying down the interest rate work? What are the benefits of buying down an interest rate? And when is it a good idea to buy down the interest rate? Well, I brought in one of the top real estate loan officers of Northern California, based here in Silicon Valley. TJ Roberts is on Facebook, LinkedIn. She started behind the scenes in the 1980s in underwriting, closing, Escrow, Appraisal, corporate training, Wholesale, became a branch manager, and she is now a loan originator / branch manager. Loan originator, of course, is a loan officer. I spoke with her a couple of times, and here is a partial interview of the first time I spoke with her regarding points. Please enjoy.
So the thing is, adjustable rate mortgage with Fannie and Freddie at this time is not better than your fixed rate mortgages. In this current market, because the rate is not stable, the yield is not stable. So they don't want to write an interest rate of 5.875 for a long term if the interest rates are going to be stuck in the sevens. They don't want to write an interest rate of 6.625 when the rates drop down to 5.875 and they paid a premium for that. And those loans will pay off. So that's why the market is so skittish onto exactly what coupon to have. So for adjustable rate mortgages, the best lending opportunities you're going to have right now are really going to be from portfolio lenders who are going to be able to hedge that product so that if they do have early payoffs and they don't get the yields that they're expecting to yield for the amount of time that it takes and money it takes to originate the loan, they're not going to be losing their shirts. By the same token, that's why they can price them much better than Fannie and Freddie can, who are your regular GSEs. So here's what I give for my new real estate agent pitch. How do I sell this listing? Rates are higher. This is the tack for the consumer, but the sellers want to know too. And what I explain to them is your property, due to the lack of inventory, your property values have remained high. One of the reasons interest rates have gone up so dramatically is because of inflation. Inflation is also what most people would consider appreciation of property, the scarcity law. So now that you've had this appreciation and the property's worth so much money, you have a smaller buyer pool who can qualify for that home. And that's why the interest rates have gone up. By having a smaller buyer pool, then you don't have those overbids. You don't have those excessive numbers. And as much as we call it appreciation, it really does create inflation.
Now hold that thought. I think where you're going is how can a listing agent and a seller how can a seller still sell their house in today's market?
Correct. There's a double pricing strategy you can look at. Interest rates are higher and costs associated with interest rates are higher. Like I explained to you before, there is no par right now. Very rarely is there a par. So what is happening is your value is supported on your property as you go to sell it at fair market value. However, your buyer can't afford to get in because their payment has gone up by at least a third. You have a smaller buyer pool. But what if you could get a bigger buyer pool keep your list price and keep the value, which is supported by the comparable sales, and have more buyers who can afford the payment by prepaying the interest on a temporary buy down, by getting them into an adjustable rate with a lower start rate, or by buying a permanent buy down of the interest rate instead of dropping your price by $25,000 or $50,000. You would double your buyer pool. You'd have the ability as a seller to not only sell to the people who need the credit from closing cost to net you the same amount, but you'd also have the ones who wouldn't need the credit, and you'd have the opportunity to lower your cost. Either way, the seller wins. They have more buyer opportunity, and the buyers win because they get into a home on a rented rate that they're going to adjust into a new fixed rate when the market changes, and it will. Once we hit a recession, which is there, when we're full blown in the recession, interest rates always have to go down. That's the only way that they can control the flow of money. And they will need to increase the interest, the ability for people to buy, and lower the interest rates. So that's when you'll be refinancing. And now you're going to have extra money in your pocket to do all those extra things you want to do as an owner of a home. And the buyer got the price they wanted, net the same, and doubled the buyer pool.
Okay, so you know the drill. And that's when I noticed that's what was my plan. I saw this coming, is I wanted to promote what you're speaking about, seller credits.
Would recommend, instead of dropping your sales price by $50,000, you do a net sheet from the title company of dropping it $50,000, and you do a net sheet of giving a credit to the buyer for $26,000, and seeing what your net actually looks like between the two, and show that's two different buyers, but you net as the seller the same amount. That's right. How you help buyers get into your property when a market's like this.
I agree. Rather than lower your price $50,000, let's use $25,000 towards concessions.
You pull the net sheet out and you do that with a big circle of here's what the seller gets in both of these cases, and here's how they doubled their buyer pool. You're still getting the same money. That how of that type of piece. That's how I would do it.
Adjustable rate mortgages, they get the feeling like, oh, it's going to go up every other month. No, it could be fixed for 5 years. It could be fixed for 10 years.
If you can, trying to be able to afford the house, but you have a solution, and the solution is a temporary buy down of interest rates, an adjustable rate mortgage with a lower start rate, and a permanent buy down of interest rates to help more consumers be able to buy your home. You have a temporary and a permanent. And then if you're asking me that question, what solutions are there out? Is the sellers are using contributions, which are completely allowed, to be able to help buyers in this rising interest rate market afford the home. And the programs that we're using are adjustable rate mortgages with a lower start rate, and fixed rate mortgages that you have a temporary buy down. So for the first year or two, they have a lower payment so they can ease into it, or a permanent buy down, which means you prepay the interest to get them a lower note rate. All of those solutions work well to get clients into a home.
When the rates were 7 and 8, 9 and a quarter, I did dozens of those seller concessions with first-time buyers, going in with less than $10,000. And they call me back when they have $100,000 in equity.
Oh, so,
thanks for your time. We'll see you next week.
All right, and I look forward to it. Okay. Thanks for reaching out.
Okay.